Non-Farm Payrolls, NFPs, are one of the most important macroeconomic reports that come from the US, the world's largest economy. In this video, we take a closer look at what are non-farm payrolls, how they affect traders, and how you can interpret this data. So, what are non-farm payrolls? Non-farm payrolls represent the change in the total number of paid US workers of any business, excluding the agricultural industry and general government employees. It's published in the US by the US Bureau of Labor Statistics. The NFPs represent the change of employment in the US economy and typically encourage a high market volatility on certain instruments, as investors seek to take advantage of the rapid price movements and react to the data release. When are non-farm payroll data typically released? It's normally released every month as part of a comprehensive report on the state of the US employment market. And it's normally released on the first Friday of every month at 1:30 p.m. GMT. Now, how do you interpret the NFP data? Traders need to understand the potential market reaction to this data before it's released. Better than expected growth in NFPs indicate that the US labour market is strengthening. That improves the prospects for the US economy. This then often has a positive effect on US dollar and US stocks. On the other hand, weaker than expected growth in NFPs can have the opposite effect. It can also trigger a rise in the price of gold should investors seek the precious metal as a safe haven. The non-farm payroll data is also typically accompanied by other important information, such as the unemployment rate, which is a percentage of the overall workforce, the increase or decrease in jobs across the various employment sectors, average hourly earnings, and private sector jobs growth, along with revisions of previous non-farm payrolls data. What is the impact of non-farm payroll data on inflation and FOMC interest rate decisions? As the global economy emerged from the pandemic and started to suffer from high inflation, the market's focus on NFPs increased in importance. It provided clues as to the potential path of US interest rate movements. The release of non-farm payroll data each month gives investors some important economic data points in analysing whether the US Federal Reserve, via the FOMC, could change its interest rate path. This is why NFP Day, as sometimes termed by investors, garners so much attention in the market. Generally, there is high volatility around any NFP release, and traders should normally be wary if they have any open positions on any instruments that could be affected, such as US indices or major currency pairs involving the dollar and gold. Please remember that even though the markets have reacted to NFP results in a particular way historically, this doesn't guarantee that they'll react the same way in the future. Also, please be aware that the markets can be influenced by a wide variety of factors, with the NFP result being just one such factor. Subscribe to XDB to learn more about trading and investing.